You're watching Behind the Headlines. I'm Pacchia. We're talking derivative reform today. Derivatives, of course, are those shadowy financial instruments that currently make up a multi-trillion, that's trillion with a T, dollar market that is still largely unregulated, even after the federal government bailed out AIG way back in 2008. The company needed something to the tune of $182 billion after it saw its bets on these products go wrong big time. Today, a subcommittee of the House Financial Services Committee was supposed to be holding hearings on derivatives reform. The subcommittee meeting was canceled, but we're going to have our own discussion here at Bloomberg anyway. Joining me now is Barry Ritholtz from Fusion IQ and Chris Whalen from Tangent Capital Partners, two of the brightest guys in the business. Man, I have the best bookers. I got to get them a present for Christmas or something because I'm just looking forward to this one. Chris, the numbers here are just huge. By some accounts, the size of the global derivatives market is larger than global GDP. We're talking about an awful lot of money, many trillions of dollars. But does the size of the market alone give cause for concern, give adequate cause for concern?
Sure. First, it's not just bigger than the 70 or so trillion dollars of GDP. It's a multiple. Depending on who you speak to, it's 5x or 10x. It's very significant. Keep in mind, most places that underwrite or sell derivatives, they're like bookies. They try and have a matched book. The problem is, as these sizes scale up, 100 trillion, 500 trillion, if you're off just a little bit of a couple $100 trillion, it's still 1% of $100 trillion is still $1 trillion.
But is size alone a reason to embark on a big regulation campaign? Chris, what do you think?
Well, it is, because ultimately these are gaming instruments. Since the size of the market is so much larger than the underlying economy, the basis, if you will, right? Then by definition, it's speculative. So that's the first point. Going to Barry's point, look at the large bank holding companies that are the major dealers. JP Morgan, a 7 basis point move in their aggregate derivative book wipes out their capital. 7 basis points. So when you look at the scale of the activity, the bank at JP is almost trivial compared to the derivatives book. The derivatives book is, in fact, the driver of the business. And whether you're talking about the London whale or customer activities, whatever it is, these people are playing in illiquid, highly levered instruments that most people really don't fully understand in terms of their performance. So by definition, it's speculative.
All right, so Barry, put your regulator hat on. How do you begin to attack a problem like this? I mean, it seems like a gargantuan task.
No, it's actually very simple. You go back to the rule change that opened up Pandora's box, which was the Commodities Futures Modernization Act of 2000, sponsored by everybody's favorite perennial deregulator, Phil Gramm. Passed something like 99-1 in the Senate, slipped in right around Christmas. No one was paying attention. Essentially, it said to the federal government, hey, every piece of derivatives are off the table. You can't look at them. You can't make them transparent. You can't require reserve capital. You can't make them disclose anything. Oh, and by the way, all the states who would have had regulatory authority under their insurance commissions, you guys can't touch this either. And you want to begin to regulate derivatives, simple. Repeal the Commodities Futures Modernization Act, and suddenly this becomes like every other financial instrument. You have to have disclosures. You have to have transparency. You have to have reserves. Look, AIG very famously said it was free money. You just wrote the derivatives and counted your cash. That's because there were no reserves.
And Chris, the reason, is really that simple?
Oh, it is. And the reason that, you got to understand what Barry just described is this retrograde evolution from an open public market based on exchanges where you have clearing members and where you have different tiers, different hierarchies of customers, and everybody is watching everybody. AIG got into trouble because they had bilateral relationships with the dealer banks who were suggesting trades to them, by the way, and no one knew what their exposures were because they weren't reporting them. Even the DTCC didn't know what the exposures are. So when you asked before the show, what is the size of this market? No one knows. We assume that the DTCC knows because they now are, in theory, managing the flow of these instruments. But no one really knows who the dumbest guy in the room is. So from a regulatory perspective, where we are today is entirely retrograde because, coming out of the 30s with all the fraud and everything else, the government said all trading will occur on exchanges, and the only exemptions were the government bond market agencies and corporates. Basically, everything else did business on an exchange.
Are you calling derivatives the modern bucket shops? Is that
yeah, it's a deliberate attempt by the Wall Street firms to escape not only regulation, but to escape transparency in a public sense. Because even you guys at Bloomberg, you've had to pay consultants for years to get close-a-day pricing on OTC derivatives because the big banks wouldn't give it to you.
It's an interesting problem, though, because it's not just about the United States at the end of the day. This is an international market that we're talking about.
Yeah.
Just a couple days ago, we saw United States and foreign regulators talk about how they're going to outline a plan for regulating these financial instruments. And I think shortly thereafter, the U.S. Treasury turns around and says they're going to exempt foreign exchange derivatives from the Dodd-Frank regulatory scheme. This is just herding cats at this point. Do we need something like a derivatives czar?
At the micro level today, down in Washington, with all the rulemaking that's going on with Dodd-Frank, the exchanges are actually winning the fight. I think you're going to see a lot of the single-name derivatives, the more plain vanilla stuff, I think is going to end up on exchanges. And the reason is that the exchanges have codified rules right now, but the rulemaking process with OTC has been slowed down. It's going to go on for years. So if you look at things like interest rates, single-name credit default swaps, I think you're going to see those migrate onto the organized exchanges, which is kind of the intent of Dodd-Frank. Unfortunately, a lot of this stuff, the FX particularly, they're going to argue that belongs in the old-fashioned FX world, which is, an over-the-counter market, never been really regulated. It's the money markets.
Why do you make that? What is the argument? I didn't see anything coming out of Treasury.
It goes back to the inception of these contracts. If you really think about where did interest rate and then credit default swaps come from, it comes from the forward market for currencies and interest rates, which is where the swap market grew up. They actually use that legal template, even though you could argue, especially with the credit products, as Barry was saying, they're really insurance instruments. Either the State Gaming Commission or the State Insurance Commissioner should be running this.
One or the other, though. You're taking, when you look at these, especially the bespoke products, you're taking two parties who hopefully both are solvent, but we really don't know, and they're making a bet as to a future outcome of something that has pretty significant ramifications. If it's about something that you have a vested financial interest in, well, clearly that's an insurance product. You can insure your own home, you can insure your building, you can insure your portfolio, and therefore there should be some insurance oversight of this. On the other hand, if I'm speculating on his house, well, then that's gambling, and it's up to the Gambling Commission to make sure that all parties leave the table and the trade actually goes through. What happened with companies like AIG, and to a lesser degree the people who were insuring securitized products, is that you had so much counterparty risk, you didn't know who could pay off their bet, who could make good on their contract. Having an exchange in the middle certainly goes a long way to resolving that issue.
Earlier in the conversation, both of you said there was a relatively simple fix to this, at least on the regulatory or legal end. Politically, however, I'm sure it's quite complicated. Assuming that under a presidential term, you really only get one grand legislative push. Should derivatives reform be that push for the Obama administration once we get to the other side of the fiscal cliff?
Well, it's not going to happen. I mean, they've already done their thing with Dodd-Frank. There are going to be significant changes, as I said. I think the easy stuff, the contracts that are easy enough to understand and trade, they're going to go to the exchanges. I think the OTC market, FX, forward money market, the real custom stuff, the derivatives with no basis, those are my favorite. Those are going to stay in the OTC world for the time being.
Politically, the window was open around February, March 2009, and the problem with the Obama administration then was they had been Rubinized. Robert Rubin had came in and put two of his acolytes in. You had President Obama, who then was a little bit of an economic naif, who basically said, Tim Geithner and Larry Summers, weren't they? Nobody said, wait, wasn't Mr. Geithner running the New York Fed? Didn't a lot of this happen under his watch? Didn't Larry Summers oversee the repeal of Glass-Steagall, oversee the passing of the Commodities Futures Modernization Act? So once, I call them the status quo duo, once the two of them were put into place, that shut the window on really substantial intelligent Wall Street reform. And instead we have this multi-headed hydra that is Dodd-Frank. It's better than nothing, but it's a giant mess. And people would even argue with me that it's better than nothing. So that's problem looking backwards. Looking forwards, hey, trust me, this will eventually blow up again. You can't have a couple of $100 trillion in derivatives with the same kiddies playing with their books and not have it eventually blow up.
Well,
so a window will open again, but it will only be after there's a lot of blood in the streets.
What's more likely, a real blow up or some real push on the regulatory front?
No, you have to have the blow up first.
Right. It's only when you get the panic in response to... Think again back to the spring of 2009 when people were running around with their hair on fire. Had you not had the status quo duo there, had you had a Teddy Roosevelt or an FDR in place, or even a Richard Nixon, who had some degree of political sophistication and understood the importance of reform, I think that Barack Obama came to understand the missed opportunity later in his term.
Well, Obama understands perfectly, and so does Tim Geithner, because as Barry said, Geithner's a guardian of Wall Street, but the thing is, the big banks aren't that profitable. The supernormal returns that they earn from derivatives subsidize the rest of the business. And this has been the case for 20 years. The Fed has said this to people confidentially in the background. They won't make this argument publicly, but the big banks are so fundamentally flawed when it comes to their basic operating profit that if you didn't have this derivatives business, they'd be in a lot of trouble.
Which does it cause them to get more aggressive in their speculation? So should we be looking at this on a year-to-year time frame, or is this a decade-to-decade time frame? Are we going to see a real problem in the next 24 months? I know it's hard to predict, but is that the frame we should be using, or is it more of a decade-based thing?
It's more frequent than you think.
But on the scale of threatening the entire system, a systemic risk amongst too big to fail banks, I would tell you to ask Nassim Taleb when the next black swan shows up. It's sometime between tomorrow and 20 years from now.
But it's not as long as people would perceive the black swan to be.
That's for certain. The other thing to keep in mind that's pretty significant about this, Thomas Honig, who's now the vice chair of the FDIC and used to be with, I think, the Kansas City Fed, has said, we need to return banking back to its roots where it's essentially a utility. It performs a quasi-public function with the backing of the government and having the Fed provide liquidity. And so, therefore, the concept behind the Volcker rule is take all this leverage junk and this high-risk stuff out and make money slowly. It was a great business until they decided
old-fashioned banking.
Right. Once they said, hey, how do we get some of that Silicon Valley type bonuses? I've always called it .com bonus penis envy. It's really what it ends up being. There's nothing wrong with getting rich slowly, and that's what, you open up a reasonable sized bank, you have a few branches. It's a nice business. You're just not going to get wealthy overnight.
Well, Wall Street doesn't want that. Wall Street has turned the top 5 banks into relatively high beta, high volatility plays. Citi trades on a 2 beta. The others are a little above 1. And, to Barry's point, the old-fashioned banking business, the equity, the common equity, was a bond. People would keep that stock for generations. They didn't even think about it because it was an income play. It was a credit play. It wasn't a trading vehicle. So this whole notion that the financials should be 20% of the S&P 500 and they should have earnings growth of XYZ doesn't fit that old world. That's part of the problem.
And it's a different world, and one would imagine that we would need different rules for this new world that we find ourselves in.
The fascinating thing is, in most sectors, in most industries, when the economy is heading for a slowdown, where there are problems in your particular space, everybody makes adjustments. They tighten their belts. Maybe there's some layoffs. Maybe you pre-announce. Maybe you lower your guidance. In the financial sector, hey, you know what? Things are slowing down. We better crank up the leverage. So go from 10 times to 20 times to 30 times, and let's see what we can do with some of these derivatives, which give us another leverage
And that's
juice.
what happened during the boom. I mean, very much. It was not only on balance sheet, but off. They were piling the leverage on. So at the effective leverage, when you took the tail into consideration with these supposedly, sold vehicles that were at arm's length, and they weren't, was very vast. It was 30 to 1 or more with some of these banks.
So instead of saying things are slowing down, let's pull in, at the worst possible moment, the banks are essentially stepping on the accelerator because that's the only way they can keep their profit growth up. And obviously that becomes a riskier and riskier approach, especially when the economy, forget a crazy, great recession, an ordinary cyclical recession where unemployment ticks up a little bit, foreclosures tick up a little bit. These guys are running so heavily leveraged, that becomes a very risky game at that point.
Gentlemen, thank you for stopping by.
Thank you.
Our pleasure.
That's Chris Whalen and Barry Ritholtz. If you'd like to learn more about the cases and issues we just discussed, be sure to go check out our offerings on BloombergLaw.com and also on the Bloomberg Terminal. You can see more of our videos on YouTube, and you can follow our updates on Twitter. I'm Pacchia. Thanks for watching.